Hi, everybody. Scott Riley, the Market Update Desk, March 24th. We're starting a new week. In fact, it's the last week of March. Boy, for a week ago, we were sitting at what, 70-degree temperature, 75, and now we got a little bit of snowflakes on the ground. So it's been kind of an interesting last 3-4 days here in West Michigan. We're seeing some interesting things with oil today. We are seeing that start to spike. There is some potential tariff situations that are happening that get announced against Venezuela or countries that buy oil from Venezuela, and that's seeing oil prices start to slide upwards a little bit as a result of that. Now, there is a few different things we want to go over today. It's going to be a really busy week. Um, we're seeing a potential move in money in the market. So potentially we're starting to see some money coming out of the bond market and into risk based assets like stocks and crypto. People are seeing a sense of maybe there's a bottom and they're trying to get the rise out of that. Now, a different reason in addition to that is there are some new insights on the April 2 reciprocal tariffs, and the scope is less than feared. So it's putting some positive spin on the bond market or equities. The administration had set a deadline of April 2nd when reciprocal tariffs would be put into place to equalize U.S. tariffs with trading partners, as well as tariffs on sectors like automobiles, pharmaceuticals, and semiconductors. President Trump said he would be flexible on the launch date. Those sector specific tariffs may now be announced on April 2nd, though the reciprocal tariffs are still expected to be announced. Additionally, the reciprocal action now looks to be more targeted than originally thought. The administration is now focusing on applying those tariffs to generally about 15% of the nations with persistent trade imbalances with us, which those account for most of our foreign trade. Now, on Friday, we heard from Chicago Fed President Austin Goolsbee, who's one of the more doves that are in the Fed. And he's a voting member this year, which is a good thing for bonds. He was asked which part of the Fed's dual mandate was more important, stable prices or maximum employment. His answer was very clear. They're both very important, but it depends on which is more out of balance at the time. If inflation were too high, they would likely have to cut. But if labor markets were too weak, they would have to look otherwise. It's almost like if you had two children, but one of them was misbehaving, you'd focus on the one that was more misbehaving at the time. Additionally, when I listened to Mr. Goolsbee speak, drill down into tariffs and the potential interpretation that they may be, here's a scary word, transitory. And I know that's a scary word when we talk about the Fed and what the Fed miscalculated before. But one of the ideas or interpretations is if the tariffs stabilize, the effect of those will be transitory within the market. So that's also why we might be starting to see some of the move back to more risk-based assets like stocks and crypto. Now, this is a really busy week. We have tomorrow home appreciation, Case Shiller, HPI, FHFA, and new home sales and consumer confidence all come out. Wednesday, mortgage apps, durable goods orders. The durable goods orders last time did not do us any favors, by the way. Thursday is the final reading on quarter 4 GDP. It's going to be telling to see what that shows us. And initial jobless claims and pending home sales. I'm going to guess we're going to get a jump in pending home sales because we're flipping to the spring market now. Friday is the big one, the bulwark of the whole week, and that's going to be the PCE, personal consumption expenditure. Now, as we do a little bit of a dive into preview of that, the core PCE reading is going to be expected to, the market's looking at either 0.3 or 0.4%. Now, as a result, that could raise the PCE year over year from 2.6 to 2.7, or even some are analyzing at 2.8%. Now, when we look into this, the replacement number that we're dropping off from last year is 0.239. So it's not a super low one. It's not super high. It's kind of middle of the road. So I'm surprised that we're seeing some of these higher expectations in the monthly PCE reading. When we grabbed our pencil this morning, Senior Analyst Mr. Gibson was busy, by the way. He gave me these notes. The components that the PCE shares with the PPI, Producer Price Index, account for 12% of the total core reading. And from those components compared to January, we can expect to see some inflationary pressure of about 0.117%. We also know that within CPI, the shelter reading fell in February from January by a small amount, and the shelter makes up 18% of core PCE. Putting that together, we could see combined compared to January about a 0.11 additional pressure from these two PCE components. Now, if we think what's going to happen is going to happen, we're putting our numbers at a monthly or a month over month PCE raise of only 0.196. Now, if that's the case, we're going to get a year over year of stable at 2.6%, and the bond market is really going to like that. So sometimes we get surprised by this stuff, but we put our pencils together and did some deep dives into these subcategories and the drill down from what CPI and PPI give us as it flows into the personal consumption expenditure. We're getting back up to date with these reports. We should be every day. We had a couple things happen last week that took our time away. I wanted to just want to say my wife's mom passed away, and my thoughts are with my wife last week, and we weren't able to get to all the updates we planned on. But we expect to be on top of everything today, and we look forward to getting you the information. Scott Riley, the Market Update Desk, 616-293-2189.